Better System Trader, episode 47.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
This is Andrew Swanscott here, and welcome to another episode of the Better System Trader podcast. This is episode 47, and I can't believe we're almost at 50 already. Anyway, backtesting. It's a key part of algorithmic trading. Now, there are plenty of options when it comes to trading platforms, and a lot of considerations which need to be made when choosing one that suits our needs. So, in this episode, we'll be discussing backtesting and execution platforms with Nitesh Khandelwal, department head at QuantInsti, who also co-founded iRageCapital and iRage Global Advisory Services. After our chat on trading platforms, we'll also cover statistical arbitrage, high-frequency trading, and some interesting audience questions, so listen out for those. Now, before we get started though, a quick word from our sponsor. Do you want to expand your knowledge of AmiBroker quickly but don't know how? Why not learn from someone who's been programming in AmiBroker for over 15 years? Alvarez Quant Trading provides beginner and intermediate courses in backtesting with AmiBroker. For more details, check the show notes page at bettersystemtrader.com/47. And now onto the chat with Nitesh. Hope you enjoy it. Hi Nitesh, welcome to the show. It's great to have you here today.
Hi, Andrew. Thanks for inviting me to the show. It's my pleasure to be here.
Well, thank you very much. So can we please just start with a little bit of background on yourself?
Sure. So I am the co-founder and the business lead for iRageCapital and iRage Global, based out of India and Singapore. We are primarily into high-frequency trading and quantitative trading. And we also have an education vertical in the name of QuantInsti, which is into algorithmic and quantitative trading training. And we have been running I co-founded these two businesses about almost 7 years back. So since then we have covered multiple geographies, and both in terms of trading the different markets as well as for training different people. So we have been doing that for almost 7 years now.
Okay, so initially how did you get started in trading?
So that's an interesting question. So I started off actually in my undergrad college. So I was doing my electronics engineering from one of the premium institutes in India. And I figured that while I was a lot interested into microelectronics, but then I also was quite attracted towards the pink papers, right? So the newspapers, pink business newspapers.
Yeah.
So it started off from there, and then I realized that it was my calling probably. So I did my MBA in finance and economics after that, after my BTech in electronics engineering, and then I moved on to actually a bank where I worked in some derivative structuring side, and then I moved to a proprietary trading desk, so to become a professional trader. And then we co-founded iRageCapital in Mumbai.
Okay, so where did algorithmic trading fit into that? Did you start with algo trading straight away, or did you kind of migrate into that over time?
So when I was with one of the boutique proprietary trading firm in Mumbai, we actually were more on the manual but model-based trading. So we started from there, but in India, algorithmic trading was allowed in 2008. So soon after that, we started off with algorithmic trading because given our background, me and my co-founders, it was quite a natural thing to actually move more towards algorithmic trading because we all had a heavy technology plus analytical and financial markets related background. So we started with algorithmic trading almost as soon as it was allowed in India, and once we had some base in India. So I have been based in Singapore for past almost 3 years now, 2.5-3 years, and we have been looking at capturing the global markets from Singapore here.
Okay, so is there a particular style of trading that you're drawn to or that you prefer?
So I am more of a believer in automation, but not to say that I would like to automate each and everything, but still to the extent possible, yes. But even if when we were doing manual trading, I was always like I would not be very keen on discretionary trading, which is based on human emotions or
Mm.
human output, but more on maybe model based. So all discretion must come from the model only. So it should not be coming from the on the go from the human mind. That's my belief. So it should be preempted, and it should be pre-modeled into your trading strategy or in the model itself, and then you can just follow it, or you can keep on the model can keep on evolving. It's not like once you have created it, it's just like that. But you can evolve, the model can evolve, but you should not have any discretion over it. It should be the model which should have all the discretion.
Mm. Yeah. Okay. And so when you're building these models, do you have a particular style, for instance, a trend following or a mean reversion? Like what actual styles of trading do you like?
So I started off as a more of a trend following trader, but we evolved into like I realized that it's if you want to have a steady flow of returns and minimize the variance in returns, then it's better to have multiple paradigms, to cover multiple trading paradigms.
Mm.
So now we cover trend following as well as market making, mean reverting, that is statistical arbitrage, as well as your machine learning based strategies, all of that. So it's a basically a full gamut of different strategy paradigms that we work on. So that has helped us in keeping a reasonable return profile, so which are not too volatile.
Yeah. All right then. Well, we might come back to statistical arbitrage a little bit later on, but firstly, one of the common questions I receive is how to choose a backtesting or a trading platform. It's probably something that you get as well through QuantInsti. So if we can just have a little bit of a chat about that first. So perhaps we can start with a very basic question in what is an algorithmic platform?
Right. So an algorithmic trading platform, any algorithmic trading platform will have three components. So which helps us to automate the whole process, and the process it would include getting the market data from the exchange or your liquidity provider,
Mhm.
converting it into something which your system can understand, then coding the strategy. That is, you're putting in the logic in your trading in your platform, the strategy logic, and then getting an order generated and sending it out to the exchange again in a format that exchange or the your LP or your trading destination would understand, right?
Mm.
So you will have APIs which are provided by the exchanges or your or the other trading destinations, fix being most common of all. So you will have market data adapter as one piece, which is converting market data into from its exchange's native format to your own format. Then you have the CEP engine, that is complex event processing engine, where all the strategy logic, that's the brain of the platform to say, in terms of the strategy logic,
Yeah.
where you are putting in your strategy logic. And then you have the third part, which is called OMS, Auto Management System or Auto Routing System, where it is the CP engine is sending the instruction that you need to send this to the exchange, this order to the exchange, and it is then converting it back to a language that exchange would understand using the API that exchange has offered or provided.
Yeah.
So that's the top view model of any algorithmic trading platform. So for most of the people, or say most of the traders, the key aspect would be the CEP engine, because there's nothing much that they will be doing in the adapter side, on the adapter side, which is on say market data side or the OMS side. So it remains the same, as in they would not be touching that, but they would be primarily focused on the strategy side. So CEP engine is the thing that most of the traders actually work in within.
Okay, so you've just mentioned a lot of different components there to an algorithmic platform. It can be quite a complicated system, but how do you, or what do you need to consider when you're trying to choose a platform that does all that?
So it would depend a lot on what exactly are you trying to achieve by using that platform. So by what I mean by what you're trying to achieve is that what kind of asset class you want to trade, what kind of frequency you plan to trade, how latency sensitive are you, right? So these are some of the very basic questions that you have to answer before you go ahead and pick up a platform, right? So I'm coming from the trading strategy, from the trading platform perspective, from the execution perspective. Similarly, from if you're coming from the backtesting side, then also you will have the similar questions to answer. So what kind of model, what kind of um, uh, the asset class you want to trade into, what kind of strategies you will be trading into, and what are all the functionalities that you need. Do you want all the coding capabilities to be present in that platform? Are you keen towards having one particular language, or you are programming language agnostic? So all those things would matter a lot.
Do you consider the testing and the execution to be separate platforms, or can you combine them into one platform?
Normally, it's a wise idea to keep them separate, because when you are putting it into the trading on the trading side, you do not want too many functionalities there, because you do not want to make your application bulky. So more lighter your application is, better the efficiency would be. So which can also provide you better latency numbers. But on this backtesting side, you want your backtesting to be as comprehensive as possible, right? So generally, it's a good idea if you can keep your um, backtesting system as well as your trading system separated out. If you have your own technology, then a lot of people, what they do is that they will use the same technology, but probably keep the backtesting side or the backtesting system much more equipped with a lot of functionalities, but use a streamed down version of the same in terms of functionality in the trading side.
Okay. Now, you did mention programming languages there. There's a lot of different options for platforms and languages. So how do you determine what the best programming language is for you?
Okay, so in terms of programming language, if you are looking at higher frequency trading strategies, then C++ is the standard. So most of the firms or HFT firms use C++ for programming on their strategy side as well as overall. But if you are and the primary reason being that the memory leaks and all those things are much less in C++, because it is not taking each and everything as object, unlike say a much easier language, Python, where you might face issues when you have a huge amount of data, or if you are looking at very high performance numbers. So there might be some issues there, but it's much easier if you're using Python. So that's why you will see so many platforms using Python as the default language these days for both backtesting as well as for coding up the strategies. Because a lot more people are coming in on the trading side, and I think that has been there historically as well, where the people were not really conversed with the technology or the programming side. So they have a good understanding of the market. They understand the quant side as well. But when it comes to hardcore programming, maybe they are not that comfortable. So Python is something which is very easy to pick on. So that's why I think Python has taken up a lot of is becoming more and more popular these days on the algorithmic trading side.
Yeah, you're right. Python has become quite a popular platform in recent times. So you've mentioned one of the benefits there is that it's quite easy to use, but are there any other benefits that people are drawn to using Python?
Oh yes, certainly. So there are a lot of scientific libraries which are available for Python. So you have NumPy, you have Pandas, you have PyAlgotrade, all those things which are readily available and can be used for Python. And also one more factor is that I think a lot of easy to use and widely available platforms like Quantopian or QuantConnect, these guys have come up with Python, although QuantConnect do offer for other languages also, but more and more platforms are coming in which are offering services in if you're coding in Python, primarily because it's more people can actually use that service. So from that perspective, if you are good at Python, then it becomes easier to use those services as well, use those platforms as well.
Yeah, sure. So those are the benefits, but how about the drawbacks of using a platform like Python?
So a platform like Python is basically, in Python you will see that almost every variable it considered as an object, right? So which would mean that it will be saving a lot of information which might not be required. Which so like on an average, this is just an estimate. So like on an average, it would be 2 to 3 times heavier than a C++ based program, C or C language variable. So when it goes to a scale, then there is a possibility that there can be some performance bottlenecks and memory leaks. So that's the primary disadvantage of using Python. But the pros very often in case of Python takes over the cons. So that's why. So effectively, if you're not into ultra high frequency trading, then it's all right. But if you're into ultra high frequency trading, then probably it might not be a good idea.
Okay, great. So let's have a quick chat about data integration, because there are some retail trading packages, for instance, MetaTrader, TradeStation, which have data built into the platform, and then others like Python, which don't have data included. So what considerations do you need to make regarding data and what you want to trade?
Sure. Okay. So in data integration, you have two things. One is your market data, so which is your general stock or forex or whatever you're trading, the market price information, and second is related to the events that are happening, right? So which is like news or economic data releases, all those things. So Quandl is something which has come up is becoming more and more popular now, and that which provides data for both your equities as well as financial market data and also your economic data. A lot of it is quite free of cost, and it covers many geographies, including Asia, US, Europe, all of that. And it you can use the API, or you can use various plugins for using in Python or even Excel, right? So that is something which is becoming very popular, since it also aggregates from, you can get it from Google Finance or Yahoo Finance or some other directly from some of the exchanges as well. So I think those who are looking for data integration, it might be a good thing to look at Bundle. And but other than, there are a lot of other data vendors which are there, of course, so who have been providing pretty good services. So that can also be done. But I believe that as we progress, as we move forward, the data integration, especially on the economic data and the news data side, that is becoming more and more. Especially with the advent of social media, those things are also affecting a lot of strategies. So I was attending a conference recently, and there was this complete discussion on the sentiment analysis in finance, and especially for the trading side. And so much is happening, and people have been using the Twitter feeds, the Facebook feeds, and integrating them and trying to draw a sentiment analysis which they are trying to use in their trading strategies. So I believe that some of these vendors, hopefully and most likely, I believe they would also be coming up with the solutions, much cheaper solutions, because right now the solutions are slightly like the ones that Thomson Reuters or Ravenpack or the other data vendors provide for machine readable news and economic data reading, machine readable economic data. So that's slightly more expensive and not really oriented towards that much towards the retail individual traders. But hopefully, as the technology gains some pace, I think we should have more and more tools where we would be able to use that data for the retail or individual trading as well. So Quandl is already providing for the economic data. For the sentiment analysis, still not there, but I'm guessing that it is just a matter of time.
Yeah, I'm sure someone's working on it already. My experience in the past, though, with free data is that it's quite dirty. It has a lot of errors. Now, I haven't actually used Quandl, so I can't comment on that. But what do you need to consider about the quality of the data?
I think ultimately, if you're very if you're highly worried about the quality aspect of data, I think it would be good to record data and use that. So that's what most of the leading firms do for estimating for creating a strategy and estimating the returns. Roughly, it's all right to use any of these data service providers. I'm not saying they do not provide correct data, but there is a possibility, of course, for some of the vendors. So it's normally advisable that you actually record the data on your own side and use that if you really want exact results, because then you know what time the data was received on your server. You're already aware of how much latency there is between your server and your and the exchange where it is streaming it from. So all those things helps a lot in making sure that what you're testing, you know what you're testing it on.
Okay. So one final question on algorithmic platforms before we move on. So you mentioned a couple of web-based platforms are available too. What benefits do they provide? Like, why would someone want to use those?
So basically, all these web-based platforms, your one primary benefit is that it's web-based, right? So you can use it from anywhere, any machine, anywhere. So that helps a lot of people. And if you're not highly concerned about latency in microseconds, or say at instances in milliseconds also, then I think it's a reasonable thing to use. It's a good compromise that you're making in latency for the ease that you are getting for automating your strategy. So that's one. Also, it does not need any development on your side. So like there are tools, so say IPython or IPPy, that you can use to connect to interactive brokers using Python. So they provide you with the API, some bridge, but there are few more steps that you need to do before you can take it live. On these platforms, you can actually just log in, and if you already have an account with one of the brokers that they support, then you can just maybe take your strategy live as well once you're done with the backtesting. So so that's adds a lot to the convenience, I believe.
Yeah, okay. All right. Well, thanks, Nitesh, for sharing some of your knowledge on algorithmic platforms. I'm sure that'll be very helpful. So let's move on to statistical arbitrage, which was one of the styles of trading that you said that you use in your portfolio. So can we just start with a little bit of a background on what it actually is? What's the underlying concept?
Certainly. So in statistical arbitrage, as the name suggests, there is not too much of arbitrage in it, but the name gained significance from the fact that most of the statistical arbitrage pairs, or the portfolios, they tend to be delta neutral or beta neutral in nature. So that's where I believe that arbitrage term got coined into pairs trading, because it was known as pairs trading when it was started for implementation, like in, I think, mid 1980s by Nunzio Tartaglia and his group, who were working at Morgan Stanley, and they were actually assigned to do something for risk management, for the risk management on the balance sheet side, to balance, so for the block trades, to hedge for the to devise a mechanism for hedging the block trades that Morgan Stanley was undertaking. And then they realized that instead of using it for hedging, why not create a portfolio where they can trade it, where they're buying one stock and selling another stock. So buying the stock which is not performing well, and selling the stock which is overperforming. And that gave up like given this idea of pairs trading, which was immensely successful at that point of time, and it was like almost a percentage returns on a daily basis that they were able to generate at that time. So obviously, not to say that you can generate similar returns now, but obviously if you come up with a maybe a new strategy paradigm, then I guess you might get to have similar kind of returns. But that is when it started, and the concept was that you are buying a stock which is not performing so well, and selling the stock which is performing really well, but both are from the same sector, same industry. And at that point of time, it was more of the rules that they had created rather than the models, because it was based on the observations, and later on probably more statistical inputs were added to it. And by 2000, I think it was like so many people have been using statistical arbitrage. So it would include your pairs trading, and similarly it also includes form of, say, index arbitrage, or any other related trading strategy where you are buying or selling, and not necessarily buying and selling all the time. If there are two things which are negatively correlated, then you might be buying both and creating a statistical arbitrage pair. so that's the underlying thing. So it's a bit of history and the underlying concept in the easiest words that I can describe.
Yeah, cool. Okay, thank you. So I guess one of the important points of statistical arbitrage is finding pairs that have some type of perhaps a steady relationship, you could say. So how do you choose those pairs? I mean, you said that they used to do same sector, same industry.
Right.
How has it evolved these days? How do we choose pairs?
Right. So normally there are few things that you need to look at while selecting pairs. First are the qualitative um, aspects of the pair. So which would be whether they are from the same sector. Second would be their services, the product and services they are offering. Is it the same, similar in nature? For example, to give you an example, if I have two companies, two cement companies, and they are both selling cement. So if I remove the label from the bag from the bag of cement, it might be difficult for a layman to differentiate between both the different two products, right? So it should be that kind of product or maybe service which they are offering, and they are similar in market size, in both in terms of market capitalization and also the revenues that they have. So this would ensure that you do not get legged out on one of the legs. They should have similar liquidity profile. So it should not be that one is immensely liquid, other is not liquid at all, and then you might have the risk of getting stuck with position on one of the legs while taking the position or squaring of the position. So these are some of the qualitative aspects, and then the quantitative aspects where you so earlier when it started, when we started putting in quant into statistical arbitrage, so it started off with correlation, where you're looking at correlation, whether the how closely correlated to stocks were or to asset classes were.
Yep.
But very soon it was replaced by co-integration. So where you look at the co-integration, whether the two stocks or two asset classes, whether they are co-integrated, whether the prices are co-integrated. Earlier we were looking for whether the returns were correlated, but now we are looking at price, if the prices were co-integrated. If yes, then we were saying that okay, then probably it might make sense to trade this pair, given that all the qualitative aspects are also satisfied.
Can you choose pairs purely on a quant basis, or does it need to also include the qualitative side?
It's always good to have to include the qualitative side, so that normally helps a lot. Otherwise, it might become at times it can become a challenge if you're only looking at the quantitative side. So what a lot of people also do is that, since say if you do not want to say if you have like hundreds or thousands of pair which are available in the market, say from the same sector itself, you take that up and maybe just do a preliminary study where you're saying that okay, I'll just use correlation, even though I know that the approach is slightly flawed, but it will give me an approximate result, and it will help me filter down my list from thousands to maybe few hundreds. And then I run my full gamut of statistical tests, which would include co-integration, testing for co-integration along with other things as well. And then I can have some select pairs. And I think after that, it might be a good idea, say if you have a few dozen pairs or say a dozen pairs, then I think it's a good idea to look at the qualitative aspects as well. You can go ahead without that also, but if the markets are running fine, if there is not too much volatility, it should be fine. But in case there is any mayhem or something, then these qualitative aspects can actually help you a bit to save some penny there.
Yeah, okay. So let's talk a little bit about the mayhem for a minute. What are some of the challenges of trading this particular style?
So the problem in the times of mayhem, while you're trading these particular stocks, is that statistical arbitrage is a mean reverting strategy. Okay, so what that means is that you're assuming that the prices will be coming back to the mean. So as in the ratio will be coming back to the mean. So ratio of the two prices, you would expect that to come back to the mean after some time. But in times of mayhem, there can be too much of pressure on the prices, on some individual sectors as well, or in some so basically there can be a lot of random movements, and at that point of time, it is possible that the fluctuations that happen at that point of time, that might trigger your stop losses, because you might not have any further margin to put in, or anything like that. I think the bigger area of concern normally in statistical arbitrage is event related risk, which are specific to one leg. So say if you are trading into two stocks, and one of the stock, there is some news of some, say for example, some fraud maybe which happened in that company, or some big regulatory step which will have a very not regulatory step that would ideally affect both the companies, but say some key management decision which is or some merger or something like that, which is expected to drive down the prices of that stock heavily. So you might get, even though it is underperforming, but it will probably underperform furthermore, because there is some big news or big announcement which has come in.
Yeah.
Right. So that is the primary risk that you that a statistical arbitrage trader will carry. But here you can see that if there was, say what I was saying in between, that a regulatory announcement or something like that which is driving down the prices of that stock, then it is very likely that if you have paid heed to those qualitative parameters, then it would have helped you, because then you are looking at the similar size companies in the same sector offering similar product and services. So most likely they will be affected in the same manner by those regulations. So it's more likely that both will be going down probably together to a similar extent. So the risk from that perspective reduces a bit.
Yeah, it's interesting, Nitesh, that you mentioned some of those issues, because I think a common misconception with statistical arbitrage is that it's risk-free, but obviously from some of the points you raised, that is not always the case.
Yes, definitely, definitely not the risk-free strategy, but relatively less risk, probably. Yes, that I can say.
Yeah, okay. So you've mentioned some of the drawbacks or the things that can go wrong, but what are the benefits of trading a statistical arbitrage?
So one of the key benefit of trading statistical arbitrage would be the margin benefits that the exchange or your broker can provide you, because you have very little delta exposure, or you're trading into stocks which are primarily which have a high degree of correlation between their returns. So you can expect a good amount of margin offset from the exchanges, especially the exchanges which follow span based margin methodology, and also from the brokers also. So that your cash outlay can reduce significantly in terms of margin that you will be paying, especially if you're trading into futures. Then also, in addition to that, what is happening is that you have a understanding of what the price bands are. So when you're trading a trend following strategy, the whole chart is your forte, right? So the prices can go anywhere, and you would like them to go anywhere, because you are hoping that it will, if it is going up, then it just keeps going up.
Yep.
But in case of statistical arbitrage, you are looking at the narrow range, so you can be more focused that, okay, if the prices are between these, and you can come up with more and more trading rules which are applicable for that range. And if it is going out of that range, then probably you can trigger a stop loss, or maybe there can be other things also that you can do. But yeah, so that's another advantage of doing statistical arbitrage. And definitely it's slightly less riskier to the market movements. So overall market movement. So if the overall market is going down or going up, that does not necessarily mean that your stat portfolio will be going up or down. It can be going either ways. So that ways there is a higher likelihood of extracting the alpha from the strategy.
Okay, and what about different environments of volatility? Have you found that StatArb works better in low volatility compared to high volatility environments, or not at all?
So we have had got this study done for like almost 2006 till 2014, sometime back, a couple of years back, and we realize that it does tend to perform better when you have some volatility in system. Not too high, but reasonably decent volatility is always good, because then the prices will be, then basically it's an opportunity based system, right? So when there is some pressure, temporary pressure on one of the stocks, and which is temporary, not permanent. So it will help. It will make sure that the price ratio reverts back to the mean in much faster manner as compared to if it was not volatile at all. So no volatility is definitely not no or very low volatility is not a great idea. But some volatility is good. But if it is very highly volatile, then again probably it's not a good idea then
Okay.
as well.
Yeah. Okay. So what do you think is the most important factor in statistical arbitrage trading?
So, in most important factor in statistical arbitrage trading would be your. I think that's applicable for any trading, but I think more so for statistical arbitrage, and that is stop loss. So what happens is that in trend following strategies, you know that if you're trailing your stop loss or as the so you can be more aggressive on the stop loss probably. So high low stop loss and high return, so high take profits. That's what normally the mantra is for trend following strategies. But in case of mean reverting or statistical arbitrage strategies, what happens is that you since so you have established that there is co-integration and the price ratio is going away from the mean, then it is the farther away it is, more likelihood there is that it will come back to the mean. So basically, you can say at a higher confidence interval that it will come back to the mean. So which means that if it is going away from the mean, I should be scaling up rather than cutting down my position, right? So which is slightly opposite to what you will do in a trend following strategy, where if it is going in your favor, you will scale up. But in pairs trading or in statistical arbitrage, you will be more often than not, you will be scaling up when it is going against you, right? So that what that means is that you will be having a big position. You might accumulate a very big position over a very short duration of time while the prices moves against you. And then if you do not trigger your stop loss at the right time and the co-integration breaks or the pair goes for a toss, then it can result into very massive losses because your position would be very huge. So that's, I think, is the most critical thing that one should keep in mind while doing statistical arbitrage.
Okay, so let me just check that I've understood the stop loss correctly, because typically a stop loss is really related to the price of the instruments. But are you saying that you're looking at the ratio between the two pairs, and then that triggers your exit?
Right. So see, from the stop loss, as a quant trader, I would define a stop loss condition or a stop loss as the time when my hypothesis fails. So my model has been based on some hypothesis. So if my hypothesis stays correct, I'm not triggering my stop loss. But once my hypothesis is broken, that is when I should be triggering my stop loss immediately. So when doing statistical arbitrage, our primary hypothesis often is that that the pair, the prices of the two stocks, say for example, is co-integrated, right? So if the co-integration breaks, which would mean that my hypothesis is broken, and once that happens, then I should trigger a stop loss. Having said that, but you might have some other parameters in your model, so where you might be scaling up your position, scaling down your positions, so which might have an impact on which might also have an impact on how much loss you can take, right? So I agree that your hypothesis might not have broken, but you might have broken, right? So your trading account might not be, might be slightly broke.
Yeah.
So in that, you need to take a stop loss. So you need to put those things into your model when you're creating a strategy.
Okay, thanks for explaining that. So for people who wanted to get started building statistical arbitrage models, what would you recommend they do?
So the idea would be to model the strategy first. First is to evaluate the hypothesis, whether it is right or wrong. Second is creating the tradable instrument, right? So basically it can be a ratio, it can be a log ratio, it can be something where you adjust few things. So I've seen people even adjusting for, like, say if you are doing a pair between US dollar index versus S&P. then they might have a very different volatility structure, which would mean that you might want to make some changes into the if you're doing it on returns or on the prices. So there are a lot of things which I have seen people doing, and some of them have been quite successful. So they create their own index, which might not be just the ratio, but they might have done certain more permutation combinations on that. So that's another step. So creating the tradable instrument, and then the pair or whatever, the ratio or whatever it is, and then you model it with all the conditions that you have in mind. So if you are looking at if how you want to scale up your strategy, what would be the stop loss trigger points, how you want to exit your trades, so in terms of profits, so whether it would be so you will be exiting all your position at once, or you will be exiting all your positions later on at separate points. So all those things have to be decided and have to be factored into the model, and then you test it against it can be simulator, or it can be some test market where you can test it on, and then you take it to live. So that's what a typical process, especially for a startup strategy, should be.
Okay. And is there any common issues or mistakes that you see traders making when they're developing these type of strategies?
Yeah, so there are definitely a lot of them, I believe. So I think let me highlight one of the interesting ones that
Sure.
people face when they are doing it, especially for the first time in a quantitative manner. So what happens is that we very often use Z-score to take the positions in statistical arbitrage, and what happens is that at times the Z-score, you have taken, say, the position entered a sell pair position at a Z-score of 2, and it comes down to, say, 0, but you're still losing money. So the people become slightly baffled with that why is that happening, because the pair has converged, it has reverted back to mean, then I should be making money. So what happens in those cases is that this what we the whole statistical analysis that we do, it is based on the assumption that the for that pair ratio, that the mean is constant, right? So basically the series is stationary, and it would happen in real life that the mean would change. It would not remain stationary. So when the mean changes, your Z-score will come back to the mean, or rather mean goes back to the Z-score, whichever way you want to put it. But yeah, so that is something that people should know, and probably factor that in while deciding their entry and exits based on, say, Z-score, which is quite popular, I believe. So that's one. And second is, I normally say that don't underweigh the qualitative aspects of it, because what happens is, in strategies like statistical arbitrage, you make money all the time, but you lose big on select days. So that's what you need to control, and so that can only happen by a combination of implementing prudent practices while creating those pairs, so which where your qualitative aspects can help. And second is by including by keeping up by being very clear on your stop loss in terms of numbers. So where is your stop loss? So that has to be pre-decided and pre-coded, so that there is no emotion attached to that. So that's another.
Yeah, sure. All right, thanks, Nitesh, for explaining that. Okay, before we get to the audience questions, let's hear a quick word from our sponsor. Do you want to expand your knowledge of AmiBroker quickly, but don't know how? Stop wasting time trying to figure it out for yourself, and learn how to do it properly from someone who's been programming in AmiBroker for over 15 years. iRageCapital Quant Trading has just released their long-awaited intermediate course in AmiBroker backtesting, which is a fantastic complement to their beginner's course. The intermediate course builds on existing knowledge and will quickly bring you up to speed on more advanced topics like custom charts, indicators and reports, working in multiple timeframes, how to scale in and out of positions, and the correct use of optimization. But that's not all. As part of the course, you'll also get full email and Skype access to Cesar Alvarez to make sure all of your questions about AmiBroker and backtesting are covered. So end your frustration of not knowing how to use AmiBroker to backtest your ideas, and take a look at the AmiBroker and backtesting courses available from Alvarez Quant Trading. Spots are limited, so for more information, check out the show notes page at bettersystemtrader.com/47. Now back to the show. Now we might just move on to some of the audience questions. We've got a few here that have been submitted. So we'll start with Tim. Tim's question is, what do you think is the most important thing before creating a profitable strategy in conjunction with choosing the right pairs to apply the strategy to?
Okay, so most important thing before creating a profitable strategy. So I think, so as I said, that most important thing that you need to do, I'm assuming it's for the pairs. Yeah, it's for the pairs. So it would be the qualitative aspects, as I just said, and also the model, how you are planning to backtest, how you are planning to test the strategy. So let me give you an example. What happens is that in a lot of strategies, so like especially if you move towards higher frequency, so on medium frequency and also high frequency side, you might not be hitting the orders, like you might not be hitting market orders all the time. You might be quoting because your margin, your profit margins are thin for every trade, as in on the per trade basis. So you might want to save on the bid ask spread. So if you want to do that, then in that case you might end up quoting on one of the legs and covering on the other leg when you get a fill on one of the on the first leg. So which sounds perfect, but when it comes to backtesting such model, it can become a nightmare because when you are quoting, you don't know how the market would have behaved if it was real market, and so simulating such thing can be very difficult. So there's a lot of work which a lot of prop firms do in creating models by using various distribution models, where the simulator can try and reflect in a way how the actual market would have reflected if such order was placed. So that's the second thing that I believe you should have in mind before you create a strategy before you start the strategy.
Yeah, okay. And there's a second part to Tim's question, actually. It says, as we know, most people are focused on entries for trading, but equally, if not more important, are exit strategies. So could you give an example of an exit strategy you like to incorporate into systems, or how you define it's time to exit?
Okay, so for exit, I believe there are two ways to look at it. One is on the when you are making a profit, and another is when you are making a loss. So when you are making a profit, the key is you do not want to exit early. You want to extract the maximum profit out of the pair as much as possible. But it's not as complicated as it would have been in a trend following strategy where you do not know where it would go. In a pair, in a statistical arbitrage, you can say that in most of the cases, people take profits around the mean when it hits back the mean. But that's not a rule, but just a common practice. A lot of people also do it. You actually wait for take the take profit slightly before before it approaches mean, just to avoid mad rush at that time. But it's a self-fulfilling prophecy, because if that is true, then everyone will be doing that, and then there would be mad rush at that point itself. So so that's it. But still, I think in most of the cases, you will be, when you are on the profit side, you will be exiting when it's reverting, when it's near about at the mean, when the pair ratio is near about at the mean. On the stop loss side, so that's where the thing is that the challenge is that you do not want to say, especially given, say, this first part is that if the co-integration breaks, then you exit right away. So that's simple. But if the co-integration is not broken, so if it is going against you, then instead of putting a trailing stop loss, what you would possibly be doing is that you will be scaling up your position. That's what the general practice is, though. So you will be scaling up your position, and normally what people do is that you will have a blanket stop loss, so that I have a blanket stop loss of say $1,000 or $5,000 or whatever amount it be. So that's the blanket stop loss for all my positions combined. If that is triggered, I'll just dump all my position. If it is not, then I will probably keep scaling up, and given my hypothesis is not broken, and then exit as it comes back into profit. Now, when it comes back, there you can have like whether you want to exit all at once, or you want to keep it so first in first out, or you want to have last in first out. Both are quite acceptable approaches, so you can do that.
All right, thanks. Now the next question is from Nikhil. Nikhil says, who would you choose between the following two candidates for your trading desk? Person A with average academic qualifications but an audited 1-year profitable real money track record, or person B with top-notch academic qualification and a profitable back-tested track record?
Okay. Uh, okay, so if it's say if it was to up to me, then I think I would definitely give more weight to someone who has a 1-year profitable real money track record. But in the end, it depends on a number of things. First being what you have traded. If that is what we also trade, that's one. Second is whether the trading philosophy or the trading style that you have implemented while making that those profits, is that the same that we do on our side. So these would be the two things which will probably affect the decision, even if it is real money profitable track record. And then also the profile that you're looking at. So if I'm looking at analyst profile, where I need someone to dig through the data and do all the data crunching, number crunching, and come up with strategy ideas, I might go with someone, the person B with top-notch academic qualification with a profitable backtest record. But if the person would be in charge of making trading decisions, then I think again the person A would get more weightage on that. And that's that. Yeah, but that's for me, but not not for the general street.
Sounds like Nikhil's looking for a job on a trading desk. Okay, the next one is from Raul. It's a similar kind of topic. What do you think is the most important factor to be a good algorithmic trader?
So to be an algorithmic trader, I think it's slightly different from how it is for conventional trading. So where in conventional trading, the things that you need are first is obviously the good understanding of the markets, then your trading acumen, which is aptitude, basically what we say. So good, you need to be good with numbers and all those things, and then it was you're disciplined, right? So these were the three primary attributes which one used to look at the convention in the conventional trading paradigm. But in algorithmic trading, I think that discipline and those things are slightly taken care of by the machine itself. Not to say that you can afford to be ill-disciplined. You cannot be, because you still have to you have to follow all the risk management conditions, and make sure that the codes are not are fail-safe. But the skill sets that are required are slightly different now. So one would be your so like this is something which we came up while we are creating the course for executive program in algorithmic trading, which is EPAT, which we offer at QuantInsti. So we thought that it has to be comprehensive. So what are the skill sets that a successful algorithmic trader would need? So one is he needs to have a very good understanding of statistics and econometrics. So that's one. So that acts as a building block for the overall modeling, as well as your strategy building, modeling, optimization, and implementation. Everywhere you will be using those building blocks. Then second is on the financial computing, so which would include your different programming languages, as well as statistical tools which you use for where you can model and test those strategies. And third one is the quantitative trading side, in which you look at various trading strategy paradigms. So like today we were discussing about the statistical arbitrage. Similarly, there are trend following, then machine learning based trading strategies, market making, and Greek based strategies. A lot of different strategy paradigms that are there, so which you should have a good idea about. Right, so these are the three primary things. So basically, it's not just the financial markets expertise, but you also need to have some amount of technology expertise, if I may say so. So that would definitely help you in becoming a better algorithmic trader.
Thanks, Nitesh. Now a question from John. John asks, for someone who wants to be a systematic trader but has no programming experience, what would you recommend their path should be?
Right. So for John, I think if you have no say if you want to be a systematic trader, it depends on whether you are looking at automating your strategies. If you are not, then I think you can pick up some basic programming skills, and that should be fine. So not too much of programming language would be understanding would be required. But if you want to automate your strategies as well, then it might be a good idea to have to gather some programming experience.
Okay. Thanks. Now there's a question here from Jonathan. We've kind of covered it a little bit in earlier. I'll just mention it anyway. So Jonathan was having some issues. He trades Forex and using the MetaTrader platform, and it has some limitations for backtesting. So he wanted to know what other systems traders use, what applications and platforms. I think we covered that quite nicely at the start of the interview. Did you have anything extra to add to that question?
I think it's so basically on the forex side, what happens is that you have more and more, like there's so many brokers and portals which offer some some platforms or the other for like almost free of cost, I believe. And I think you might want to have a look at them as well, in addition to the ones that you're already using, like MT4 and all. So it might be a good idea to have a look at them also. That might help if in case if MT4 is not catering to your requirements.
Yep, sure. Okay, thank you. And final audience question is from Michael. Michael would like to know, what do you think is the future of trading?
Okay, so now, as you know, my background, where we are into high frequency trading and automated trading, so we tend to believe that automation is the future, but we also often say that future is already here, because like even in markets like in US markets, especially in equities, you have more than 70 to 80% of the exchange volumes which is happening through automated systems. Even in nascent and new markets, like where the algorithmic trading is relatively new, like India, you have more than 50% of the volumes in derivatives that is happening through algorithmic trading systems. So that is something that has, I would say, that already have already arrived and will arrive where it is not the case. But what would be more interesting, as I was saying earlier also, would be the inclusion of all the various miscellaneous data which is floating around all around, and especially with the recent advancement that we are seeing in the big data analysis and analytics. It would be not a surprise if you start seeing a lot of data gathering and data analysis which is happening outside of financial markets, and which tends to affect financial markets, and you see people building bridges between that and using those for creating trading strategies. That is something which I believe is not yet there in full purview, and I'm sure that would come. Rest all things like arbitrage or market making, they will keep on evolving. I think the automation has helped now market makers to make markets in a much tighter fashion as compared to what it was, say, to probably 25-30 years back, when you only had specialists in the pit and making very wide markets. So your trading costs were used to be huge, but that is no longer the case thanks to the technology advancements. And I think all those things will continue to happen, similar to how we have seen in automobile industry. It just came to my mind, so I thought I'll just say it. So let's just like earlier on the shop floors, you used to see all the workers who were assembling the parts and doing all those things. And as the technology advanced and you saw those shop floor workers to be replaced by the machines, not to say that these machines are operating by themselves, they are automated, but someone is definitely controlling it. So you just keep on improving your skill sets to go up in the value chain, and in the whole process, the process becomes much more efficient.
If I can ask you a little bit more about high frequency trading, actually, because there's been some reports published on the internet showing that the profits from high frequency trading is in decline. So do you think, I don't know if that's actually true because I don't work at a HFT shop, but do you think the edge there is being eroded away, and do you think we'll start seeing less high frequency trading over time?
So I think what is happening is that there is more of so the technology cost have been increasing for the top players. So if you want to be the fastest guy in the market, then it is becoming more and more expensive to be that. So earlier, if you were at 10 micros, your system latency was at 10 microseconds, you were a happy man. Now even if you're at 5 to 6 microseconds, you're probably would not be able to compete if you're into on the high frequency side.
Wow.
Right? So people have invested a lot, and it's not just that in the on the technology side, but also on the infrastructure side. So you had earlier the cables, the optic fiber optics, and then which gave room to microwave now, which is becoming more and more popular, and now then you have laser, which is coming in, right? So and the thing is that whichever is the latest technology, it would be absurdly expensive. So it seems to be that, because that can give you that kind of profits as well. But that is becoming more and more difficult for the general people in HFT. So only the premium within the HFT is able to compete on that side. So the volumes are still there, but just that probably the number of shops would probably decline, or maybe it might have to go through a consolidation phase a bit. And what is also happening is that more and more companies are moving more towards the machine learning side, where you have more logic that you can program and use that as an edge, as compared to just the speed advantage, which is becoming like the base is common for everyone, and then the improvements, the further enhancements are becoming extremely prohibitively expensive for a lot of people.
That's interesting. Thanks for sharing that, Nitesh. I might start wrapping up now with some quick closing questions.
Sure.
What's the biggest lesson you've learned through trading?
So I think the biggest lesson that I've learned through trading, or while I was doing trading, is that trading is not just buying and selling. If you want to be successful in that, you need to treat trading as a business. So like in any business, you need to, if you want to succeed, you need to have certain competitive edges. So same thing applies here as well. So if you want to succeed in a trading, if you want success for your trading strategy, then you need to have certain competitive edges that you need to gather. It can be anything. It can be your trading strategy itself, or the speed at which you can come up with new ideas, or it can be your infrastructure technology, or it can be your low brokerage, or it can be the markets that you have access to. It can be anything, but it has to be a mix of competitive edges that you need to work towards gathering them to make sure that you are profitable. So just like in any business, you will do that. And even if you are opening a grocery shop, you will probably look at the competitive advantages in terms of what kind of rent you're paying, what kind of location you have your shop at, how you're procuring those goods, right? So it's the same thing. You need to treat it as a business.
Yeah, great bit of advice there. Thank you. So what advice would you give someone who's just starting out in the algorithmic trading field?
I think what I would suggest is that build your base right first. Instead of trying to put your strategies into live environment as soon as possible, it is better to understand the nuances. Because one thing that you need to understand about algorithmic trading is, or when you're automating stuff, is that when it's a human brain, or a human when a person is analyzing things, or making trading decisions, he has the advantage of common sense, right? A machine does not have it. It has as much common sense as you program it for,
Yeah.
right? So there are certain nuances which might not be. So you might be excellent trader, but if you're switching to algorithmic trading side, it might be a good idea to build a good base there to get a good understanding of what are the different factors and what are the various skills, like on the programming side or on the analytics side, quant side. So you better brush that up.
Yep. Okay. Do you have any favorite trading books?
Actually, I'm not so much into the fiction side, but I think I have enjoyed the ones with some drama in it. But I think on the non-fiction, so like all the classics, the old classics, few decades old, I guess, so like Liar's Poker and all those ones up, or the reminiscences of a stock trader,
Yep.
stockbroker. So that's I think I like that. On the non-fiction side, I believe I like the investment psychology by Murphy. So I like that quite a bit. So that's. It's been a long time since I read that, but I definitely remember a lot of things that I read in that book. So I think that's really nice. Yeah.
Okay, great. So I think you mentioned earlier you're part of QuantInsti. Did you want to just give us a quick little explanation about what that is?
Yeah, sure. So QuantInsti is into algorithmic trading and quantitative trading training. So what we do there is that we provide the comprehensive programs, which is executive program in algorithmic trading, which is 6-month long program, weekends only, targeted towards working professionals, and done through a live webinar setup. So that has actually enabled people from more than 30 countries across all the 6 inhabited continents to attend to participate in our program and get benefited from that. So and it includes all the various aspects of algorithmic trading, and not just like stats and financial computing and quant trading, but also even from the regulations perspective. Say if you're trading in US markets or in emerging markets or in any other developed market, so what are the regulations that you need to be aware of? What are the compliances? Even that side, along with the technology and network hardware infrastructure. What are the tips there? What can do the trick for you? So all those things also we cover. It's a highly practical oriented program, and yeah. So if so it has received good reception in the past 5 years since it was launched, and yeah. So I think that should be it. We are happy to keep offering that program, and it has we have also been able to actually gather the globally leading faculty members, so like the domain experts within their different domains. So like Professor Dr. Eve Hilpsich from Germany, who the author of Python for Finance, who has been leading on the Python module for EPAD. Similarly, for trend following strategies, we have Dr. Ernest P. Chan, who also wrote Introduction to Algorithmic Trading, which is very much like a textbook in a lot of at a lot of places. So he's based out of Canada, so he takes those sessions, and then similarly other practitioners at iRage and otherwise who take up the different modules as per their expertise. So it's been good.
Oh, that's great. I actually know someone who's been through the EPAC course, and the feedback was pretty good. So if anyone's interested, check out the website and see what it's about. All right. Well, thanks so much for your time today, Nitesh. Is there anything else that you'd like to mention before we wrap up today?
I think I'll just say one thing, that prepare yourself well and make a lot of money.
Yeah. Well,
Yeah.
I think preparation is important because it's not an easy job, is it?
Yes, yes, I definitely agree. So you need to put in, and it has to come through practice. A lot of it has to come through practice. So yes.
Yeah. Excellent. All right. Well, thank you very much again for your time today, Nitesh. It was great.
Thank you so much, Andrew. It was my pleasure having here.
Yeah, thanks. You gave us some great tips on how to choose an algorithmic platform and some great tips on StatUp as well. So thank you very much for sharing all that fantastic knowledge with us. I'm sure people will find it valuable. And I wish you all the best for the future.
Thank you so much, Andrew. It has been wonderful having been here, and thank you. Thanks a lot for
Thank you very much.
inviting us. Yeah.
All right, cheers.
Thanks. Bye.
Okay, bye-bye.
Cheers.
Okay, so a big thanks to Nitesh for chatting with us today. If you want more info about anything we covered in this episode, or would like to download a transcript of our chat, check out the show notes page, bettersystemtrader.com/47. And while you're there, why not leave a question or a comment in the comment section? I'm really interested to hear what other traders are using for their backtesting and execution platforms. Anyway, that's it for this episode. I hope you enjoyed the chat with Nitesh, and I'll catch you at the next one. Thanks for listening to Better System Trader.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.